So I have shared this template. कुछ करा आपने इसके? Who has done it? आपने कर दिया. Up to what level?
I filled the price, market cap and EV.
Price, market cap, EV.
फिर नीचे जो टेबल है वो फिल करा तो
ये वाला टेबल?
नीचे.
अच्छा, नीचे वाला टेबल. So we are going to start slowly, gradually, so that other people join. So basically, this is the exercise, which will help you out in a great deal to understand this mechanism, okay, and to understand, what stocks, how the stocks are performing, and either they are overvalued or undervalued or fairly valued, okay, and that is one of the purpose. Basically, the topic that we are doing is valuation. So we must know whether the stocks are overvalued, undervalued. If they are undervalued, it's a time to buy them, okay. If they are overvalued, then it's time to not to buy, okay, or to sell them because they may fall if you are holding them. So now what you have to do is basically you have to this is the filled format which I am going to share, complete one, okay. Today by the time we finish, I'll share the complete filled format, okay, fine. So you know this is the prices. So these prices ये prices कहाँ से मिलते हैं आपको? ये जो price है, stock price आप कहाँ से ले रहे हो? Screener से, okay. So Screener will help you, or any financial site will help you to get the prices, and the price will keep changing. Every day the price changes. So this is a little bit older, this thing. So the price has changed. Then the market cap, okay. So there is no issue to calculate the price. What we are doing is basically we have just chosen all the cement companies. So there are 7 cement companies. There are about 14-15 cement companies which are listed on the stock exchange. But we have chosen only 7 because the screener has given them as a peer companies. Okay, so 7 companies we have chosen, and they constitute the 50% market share of cement. That means 50% of the production or sales which is happening in the country is done by these companies. Okay. So which is a fairly good representative sample to understand and analyze the cement industry. Like in your, when you do your own exercise as a project, you have to choose your own industry. It can be, IT industry or a FMCG industry. So that's up to you. So whatever industry you choose, it's fine. Even if 2 groups choose one industry, no issue. Okay. So then we'll analyze the industry. Why we choose the same industry? What's the reason? Because when we are doing relative valuation, we are taking comparative companies which can be compared. Okay. Now this is the simplest way of looking companies which are comparable. But sometimes these companies may not be comparable at all. But because they are from the same industry, we say that they are comparable. But the real definition that the companies are comparable is something slightly different, which I'll talk later. Okay, fine. But since this is the easiest, because it's very difficult to find companies which are comparable because of the strict definition which is given in the textbooks, so or in the real life. So to find those companies, it takes time. Okay, fine. And so these companies are within the same industry. Fine. So they are comparable. We understand that they are comparable. Okay. Fine. So now, because cement, is the companies are comparable because cement companies are making cement, isn't it? And cement is used for either making houses, or for making commercial buildings, or for making any construction. Okay. And these cement companies, they don't look at who is the customer, whether it's a residential real estate or the commercial real estate or whatever, or factories are being made. So where are supplying it? So as such, they are comparable. But sometimes, the companies are like, a paint industry. For example, Asian Paints. Okay, they are focusing only on household paints. Okay, 90% is decorative paints. Fine. But there are some other companies which are supplying paints only to automobile companies. Okay, so the paint companies can't be compared because one customer is a automobile or a transport company. Okay, they are supplying mainly focusing on them. Another is supplying only to the retail customers. Okay, so then that comparability get lost. Okay, So that's a reason that, within the same industry, companies can be said to be comparable or even cannot be said to be comparable, depending upon if they have a common customer base, then we say they are comparable. So in this case of cement, there is no demarcation. Fine. The cement is purchased by every a user, whether it's an industrial user or a retail user or whatever. So everybody is buying. So they are comparable as such. So I'll go by the definition, they are comparable. Okay. Now, as we look, certain indicators, we'll find that all are comparable. Okay. Because there are certain indicators, 2 indicators are there, which we're going to discuss later. If you just, measure whether they are comparable on those 2 indicators, you'll find they are comparable, all the cement companies. Now, here we have 7 companies: Ultratech, Grasim, Ambuja, Shri Cement, JK Cement, Dalmia Cement, and ACC. So I told you one of the company is, can be excluded from our this group. Which is that company? Because Grasim is, itself is not. Ultratech. So it owns 100% of Ultratech. So Grasim, financials, they include Ultratech financials also. जो अल्ट्राटेक की सेल है वो ग्रासिम की सेल में जुड़ी हुई है. ओके. एंड ग्रासिम एज सच इज नॉट डूइंग एनी सीमेंट दिस थिंग. द होल्डिंग कंपनी डजंट सेल एनी सीमेंट, so it is coming because as a whole it's a cement company also, and because Ultratech is the largest cement company, so it is almost 50% or more of the market of the shares are held by by Grasim. So it is again a cement company, so it is coming in the list. Fine. And if you exclude a company like Grasim, it can distort our analysis also. So normally they should be excluded for doing this relative valuation, but I have included it. Okay, fine. But if you come across, you can exclude that. But just for the purpose to explain, and then we can exclude it later on and see what impact it has on our analysis. So then we have the market cap. Okay. The market cap is again coming from screener. That means the total value of the shares of the company. That means the share price multiplied by the total number of shares which the company has issued. That's called the market cap. So it's a value of a company in terms of shareholders' value. Okay, fine. So then we have EV, which is the total valuation of the company. Okay, which includes debt also. Fine. It is the market cap plus debt minus excess cash, which means it is by definition, it is basically the market value of the market cap of the shares plus the borrowings company has taken minus the cash, because here we are considering only market value of the operating assets of the company. Okay. So and cash which is lying with the company is not, they are not using it for carrying out the operations. They are just lying, as a reserve which has been parked in some kind of, investments, which whatever return you are getting, it's not a business return. Okay. So that's why we exclude the cash. Okay. So that whatever we get, it becomes the assets, the market value of the assets which are basically being used by the company for carrying out its business, carrying out its operations. Then we have, now these are the 3 things which we calculate, and then the 4th one is the sales, the turnover. Okay. Fine. How much top line the company has done. Here, when we go to the screener, we look at the TTM number, trailing 12 months number. That means if the company has announced, companies announce quarterly results. Every quarter the company is announcing results. So we want to know how much sales the company is doing in the last 4 quarters instead of in 1 year, which has been audited by, or which is the final, which is given in the annual report. So annual report will come only after a year is over. Okay. So we disregard that sales. We include the sales made in the last 4 quarters. Okay. That number has been calculated by the screener, so you don't have to do it. But you can cross check if you want to just clear your concepts. If you add the 4 quarter sales, you will find the sales in the TTM number is same. Okay. So sales. Then we have EBITDA. So earning before interest, tax, depreciation and amortization. So, a lot of people call it by different name. It is proxy to cash. Okay. It's like how much cash profit the company is earning, isn't it? Because it is, excluded the depreciation and amortization, because depreciation and amortization is just a cost charge. So there is no cash outflow which is happening after you charge depreciation and amortization. So that is not a cash expense. So if you exclude that, will come EBITDA. Yeah.
Sir, actually, in this EBITDA value is not correct because operating profit is linked in this. Actually, when we look into D36 cell, it is operating profit.
Yeah. So this is operating profit 3,094.
So we have to link the EBITDA value.
Okay. So I have linked this. Okay. If I say EBITDA, then if I go down, then it is 14,000. Okay. Fine. And if I just see the formula here, I'll tell you the reasons for it. So basically, it is sorry, not the formula. So it is, interest, depreciation and profit before tax plus interest and depreciation. So we get EBITDA. Okay, fine. And the operating income is I have taken as EBITDA. Okay, fine. So I'll tell you why I have taken it, and then I have calculated EBITDA separately. So you can you have taken from EBITDA, not from the operating profit. So that's fine. Now what happens is that various financial sites they have their own definition of calculating EBITDA. Okay. Now one other site calculates, maybe the screener calculates the operating profit as EBITDA. That's why I've shown there. We'll just check that. And what is the difference between both the numbers? I'll just say first. So this is the EBITDA. Okay, fine. So what I have done is I've just gone to, for example, I've gone to Ultratech. Okay, if I go to sales, so what I have taken is I have taken 13,924 as EBITDA. Okay, whereas in the columns which I mentioned, I have taken the profit before tax. That means profit before tax 8816 plus the interest and depreciation. If you add, it will come earning before interest and depreciation. Okay, fine. So so then what is the item which is not there, which is the other income? The only difference is the other income, isn't it? Where there is some kind of a goof up or some kind of a manipulation. Now, if you look at the other income of a company, okay, as I told you, the other income will have two kinds of incomes. One is called other income normal, and another will be exceptional items. Okay. So that means a company earns income, other income, through two kind of subcategories. One is the normal other income, like company may have, company has deposited some money in a fixed deposit. Okay, it's earning interest. It is a regular source of income for the company. So it will become other income, normal one. But if the company has sold some shares, like Reliance has sold some shares in the last quarter of Asian Paints, and they have made a 3 crore rupees of profits. Okay, 300, a lot of money. Okay, let me just check that. Okay, so that is exceptional item. Okay, so let's go to Reliance and see. So if you look at Reliance and look at the other income. So other income, if you look at other income, there is a 15,000 other income is there. Okay, as against a normal other income is 4,000 every year. A quarter of the other income is 4,000. So if you just go here, exceptional items 8,924 crores other income. It's a big chunk. Okay, it's a big chunk. Now that income which the company has earned is by selling share. It's a one-time income. It is not going to repeat. Okay, company has sold. Suppose here they have sold all the Asian Paint shares. Now they don't have, so they can't encash. Even if they have, I mean, they'll not do it every month. Okay, so now the other income can distort the profit of the company. It may look the company has done exceptionally very good in this quarter, but and you may take a decision that I may buy shares, but actually it is not, because this income is going to be one-off. Okay, so what the analysts do is they exclude this other income for calculating operating profit or EBITDA. Okay, fine. So and that's the right thing to do. Fine. And or sometime you just forget that and take operating straight away operating profit. Okay, which is actually excluding everything. Even the normal income has been excluded. Other income has been excluded. Fine. Whereas the normal other income should have been added to the EBITDA. But and when you take operational income from this sales minus thing, operating profit is nothing but EBITDA again. You can even say that it is EBITDA. But without a normal other income. If you add the normal income, then that should be the EBITDA. So that's the difference. Okay. So if you are just using Screener, but if you go to some other sites and try to check, then you will find that there are some differences. That's okay. Okay, everybody, because in accounts, finance, people are subjective. But I am of the camp that other income, normal other income should be part of EBITDA. Okay, whereas any exceptional income should be excluded from EBITDA. Is that okay? Fine. So anyway, so we will make a check. So whatever I have given, you can check. You can do the EBITDA and link it instead of taking operating income. Okay, maybe that what I have done is not right. This doesn't go according to my own understanding. Okay, but very sites give this. I mean, take operating income also. Okay. Now what we'll do is that when we have put this, we will check these ratios. If they are matching, then we say, okay, this site has chosen this as a definition. If it is not, so there will be some price earning ratio or EV to EBITDA. So you'll find some kind of a variation. Okay. So EBITDA is okay. Okay. Now, what is EBITDA? EBITDA is full form of EBITDA. Yeah. So it is basically whenever we make a profit loss of a company. Okay. Now, when we make a profit loss of the company, so we calculate profit of the company. Okay. The real profit of the company is not the net profit. It is EBIT. Okay. And then if we add depreciation and amortization become EBITDA. So EBIT is the operating profit of the company. Okay. Fine. Even it is after taking out the depreciation and amortization, you will get EBIT. So EBIT is the operating profit of the company. That means how much the company has earned by using all the resources, all the types of capital, whether it is borrowed capital or whether it is the equity capital. Please listen very carefully. So when you are comparing two companies on an apple to apple basis, the best way is to understand what is the EBIT or EBITDA rather than the net income of the company. Because the net income of the company can go up and down because of the leverage play out. Because the leverage, what is that? Because if the company has borrowed more, okay, the company in good times will show higher profits. Okay, and then I'll just tell you how. Okay, please focus. Now, if the company has taken, a loan or borrowings, okay, and company's profits will gallop, and the net income will also go up, or it can be vice versa also. It can have a very positive impact, it can be a negative impact of the borrowings. Because that debt, which is now, debt is cheaper than equity. When you have to do business, you have two sources of money. Okay, fine. You can either put your own money or you can borrow money. Now, there are two sources of capital. So that means choice is yours, how much you should be doing your business from the borrowed capital or how much you are going to do it from your own capital, that is equity capital. Now, as I told you, normally I ask this question, which capital is costlier, equity or debt? So if I ask you this question, which capital is costlier, equity or debt?
Because debt is tax deductible.
That is?
Debt is tax deductible, so it's slightly less costly than equity.
Good. One of the reason, because the debt is tax deductible. Okay, so one reason. Whereas why equity is costlier?
Because it is firstly not tax deductible.
What is not tax deductible in equity?
Sorry.
Equity में क्या deductible नहीं है?
Tax.
क्या equity में tax को क्या लगता है?
Like if you put your own money into your business, if you put your own money into your business or you have some.
No, what is not, give me an example. I'll just tell you, listen to it. Okay? Now, when you have an equity capital, you are going to declare a dividend, isn't it? So the equity shareholders are going to get dividend. But if you have taken a loan, what the loan holders will get? Interest. Interest मिलेगा ना उनको. So interest is tax deductible, whereas the dividend is non-tax deductible. Dividend is what? Appropriation of profit. Like the owners have earned profit and they are distributing among themselves. So government says पहले tax pay करो और फिर distribute करो. So dividend is an appropriation of profits, whereas interest is an expense to the company. So that's the difference. Is that okay now? पता था पहले? थोड़ा ऐसे इतनी clarity नहीं था. Okay. So dividend is what? Dividend is not dividend is a appropriation of profit. Dividend is what? Appropriation. It is not an expense. It is distribution of profits among the shareholders after the company has earned profits. So government says pay the tax and distribute among yourself. भाई पहले tax pay करो. So इसका मतलब जो dividend है that is not tax related. Okay. Now, when you take the money, Shruti, please. When you use your own money, okay. Suppose you do a business, okay. You have your own money. How much return do you expect every year? कितना मिल जाना चाहिए आपको तभी आप business करोगे? Just think about what kind of percentage. It should be 5%, 10%, 15%, or 20%. More the better thing. Okay? 15, 20. Okay. Fine. So you expect a higher return, 15 or 20. When I said 20, say 20. If I said 25, you say 25. Okay. So if you are putting your money into equity, you are satisfied only with a higher return. But when you give the same money in form of, somebody borrows the money from you. Like suppose the bank borrows the money. That means you go and take a fixed deposit with the bank. How much return you get? आपको कितना रिटर्न मिलता है ऑन अ फिक्स्ड डिपॉजिट श्रुति? 6 to 7%. Are you happy? Yes, because you think that fixed, it's a fixed interest. You know that my money is safe. There is no risk involved. When you give a money on an equity, there is a risk involved. That's why you add a risk premium. You want a higher return because you always worried that you may not get your return at all. Sometimes your money may become a negative, okay, and you may lose your entire money also which you have given to the company. So the equity has a risk component, whereas a fixed deposit or a borrowing, even by a company, when the company takes loan, there is a less kind of a risk attached to it, because when a company borrows from a bank will take all the assets which the company owns and unko mortgage kar legi. So banks are comfortable that anything happens to the company, they can sell the collaterals and get their money from the company. Okay. So the equity is riskier. Equity is riskier, and you will only put your money if you think the returns are greater than the fixed deposit. Like fixed deposit you get about 7%, or you put the same money in a government bond. Government bond is also giving around close to about 6.5% nowadays. Okay, FDs give little about 7%. So the government bonds are the safest. Okay, so you want a higher return than a fixed deposit or a government bond. Now normally we talk about a government bond rather than a fixed deposit when you're talking about a risk-free asset. The most risky asset is when you give the money to the government, not to a bank. Even the bank, when you give, the bank can fail. Sometimes you find that, in the morning you just open up the TV and find a lot of people are, in front of the bank. They are not getting their money, the ATMs are not working. People are saying, the banks have, closed their ATMs, they are not, repaying the money back. So there is some kind of a risk also in a fixed deposit. But still, we ignore that. We say that ICICI Bank, Punjab National Bank, or, HDFC Bank, they are great banks. And the fixed deposits are insured up to a certain amount of money. Maybe I think 5 lakhs, 10 lakhs, or 1 lakh, I don't know. So up to a certain amount, your money is insured also. So you know that if the bank fails, the insurance company is going to pay the bank and bank is going to give you the money. Okay, fine. So as it is mandatory for all the banking companies to get their fixed deposit insured. Okay, fine. and up to a certain amount. Suppose if you have 1 crore fixed deposit, then there is a risk involved, because up to that amount you will be always under risk. So since, now tell me, okay, just raise your hands and tell me why equity is costlier and debt is cheaper. Just raise your hand who can raise. Okay, just I may not, or I may not ask, but just first of all, just a check that everybody knows about it. If you know that, the equity is costlier compared to that, and the reasons, I'm not asking you the reason, just raise your hands if you know that. Just raise your hands. आप हाथ पे खड़े, अभी तो बताया मैंने equity क्यों महंगी है compared to debt, ये पता है, बस आपसे पूछूंगा नहीं, ओके, आपसे आंसर नहीं मांगूंगा, बट जस्ट रेज योर हैंड्स, raise your hands if you know. There, everybody knows that. Okay, fine. So does it require explanation again? नहीं. अगर चाहिए तो just watch my video which we have just discussed. Okay, so equity is costlier and debt is cheaper. Now if the debt is cheaper, so that means the company will gain if they deploy debt. If the company uses more and more debt, it can gain, because it is offering only 7, 8, 9, depending on which company is borrowing money, asking for money for the bank, depends upon their credit rating. All the companies have credit rating. Okay, there at the back. All the companies have credit rating. Okay, who does the credit rating? Can you just let me know which are the companies who are doing credit rating? Any company? Rashika? Any company? ICRA, CARE, S&P, Standard Poor's International Company, ICRA, CARE, all these are credit rating companies. They are big credit rating companies in India. Okay, they do the rating. Okay, credit rating. This is mandatory for all the big companies who are borrowing money from public or from bank or issuing debentures, bonds. They have to get their company rated by a credit rating. Like all the countries are also rated. Like USA was having a AAA rating. AAA is the highest rating. Now there are two kinds of borrowings. One is for just a short time purpose, for 1 year or less, and sometimes we borrow for 5 years, 10 years, so that's a long term. So the ratings are also split into long term ratings and short term ratings. So when you approach to a rating company like ICRA or CARE, so they'll ask you what kind of rating you are looking for, a long term rating or a short term rating. Okay, now if it is a long term rating, then all these rating companies, they're using their own symbols. Okay, AAA is the best rating. That means whatever money you're giving to a company which is AAA, okay, please focus here instead of focusing on your own things. AAA is the top rating, which means that if you are giving your money to a AAA rated company or a government, that your money is the safest. Then comes a AA, then comes a single A, then comes triple B, double B, B, then comes C and D, like this. Okay, so C or D are called junk ratings. That means your money is at risk. Okay, so when you give money to someone, you must know what that company has the rating. Okay, now as per India RBI regulations, all the companies which are AAA rating, AA rating, single A rating, or up to a certain level, they are allowed to go and raise money from a bank or from a bond or debentures. Other companies are barred because the government wants a safety, that persons who are giving money, taking loan, they should be solid, so that people should not lose their money. So let's check that. Okay, suppose you want to know to check the rating of a company. So where you'll go? You'll go again to the screener. Okay, screener has everything. Okay, so this is Reliance. So go to investors. Okay, or go to doc. Okay, go to doc, rating update. So look at the rating here. So we have got the rating, and CRISIL has given a AAA rating to Reliance. So that means your money is absolutely